Good afternoon and welcome everybody to the Paladin Financial second quarter webinar, Unlocking the Hidden Benefits of Life Insurance. I'm your host, Jeff Quick. I'm an investment advisor representative with Paladin Financial. I have over 20 years experience in the financial services industry, actually closer to 30, but 20 makes me feel better. So we're gonna go with 20. I am the past president of a tax firm. I have all my securities and insurance licenses and have trained advisors all across the country on various topics. So let's get started here today. The evolution of life insurance. Number one, life insurance has evolved from what started as really a death-only protection tool to a flexible financial planning instrument. Modern policies can serve as a cornerstone of retirement income, tax efficiency, and legacy planning. A few of the topics we're going to cover in more detail today. One, life insurance with long-term care coverage, how to take advantage of cash value accumulation, tax-free income, as well as tax advantages and wealth transfer. When most people think of life insurance, they think of one thing. It's typically income replacement, and for good reason. For decades, that was its core purpose. You bought a policy to protect your family if something happened to you. The benefit was simple and straightforward. Provide your loved ones with the financial support they need if you were no longer here. But today's life insurance has evolved dramatically. Modern policies have transformed into multi-purpose financial tools that do far more than just pay a death benefit. One of the most significant shifts has been the integration of cash value accumulation. Many permanent life insurance policies now build cash value that grows on a tax-deferred basis. In the past, there was term insurance and whole life. Those two still exist, but fast forward today, and you also have different tools for accumulating cash value. You have indexed universal life policies, which typically tie to an index and eliminate the potential for loss of premium. And then you also have variable universal life policies, which are typically tied to mutual funds, have more growth potential, but there is also a risk of loss of those values. Incorporate hybrid policies into that, and now it's a multi-use policy. And with proper planning, that cash value can be accessed tax-free, providing a supplemental income stream in retirement. Could be for funding college, act as an emergency savings reserve. In addition to the cash value, today's policies can also play a critical role in estate planning. For high net worth individuals, life insurance can provide liquidity to pay estate taxes, fund trusts, and facilitate tax-efficient wealth transfer across generations. In fact, using tools like irrevocable life insurance trusts, oftentimes referred to as ILITs, can help keep the policy out of a taxable estate entirely. But that's not all. Life insurance can now also address one of the most pressing concerns for retirees, long-term care. Many modern policies come with long-term care riders or chronic illness benefits, allowing policyholders to access their death benefit early to pay for home health care, assisted living, or nursing home costs. It's a smart way to protect against the rising costs of care without losing the value of the policy if care isn't needed. In short, life insurance has come a long way from being just about protecting your family after you're gone. It's now a dynamic, living part of your financial plan, helping with retirement income, tax strategies, wealth transfer, and healthcare planning. That's why it's so important to review your life insurance, not just as a cost, but as an asset. When properly designed and integrated, it can provide security, flexibility, and value throughout your lifetime, not just at the end of it. Let me ask you a question. How much do you think you will spend on healthcare and medical expenses in retirement? Well, according to CNN Money, a couple who retires at 65 can expect to spend $300,000 on healthcare and medical expenses. If we look at the typical costs of care today, just an independent living facility alone with no additional care needed you're looking at about $2,784 per month on average in Minnesota, or about $33,000 per year. As you progress and may need some assistance, those costs double. Now we're looking at $5,500 per month or $66,000 per year. Again, as you require more and more care, nursing home care, for instance, or at the top of the pile, we have memory care facilities that can be upwards of $15,000 per month. So now we're talking about an excess of $150,000 per year. Most people I speak with do hope to age in place or receive in-home care, oftentimes provided either fully or partially by a family member and then supplemented with paid care. So these costs can become quite high. Now we need to determine, we know we have a $300,000 bill coming. How are we looking to pay for that? Well, there's different ways. You can self-fund. A lot of people are able to do so either through monthly income, savings, investment, retirement accounts. You may choose to use your home. Maybe you're generating rental income. You could obviously sell the home to pay for care, or look at a reverse mortgage loan against the property to pay for home health care costs. You could also utilize insurance, standard long-term care insurance. We're going to talk a little bit about life insurance with a long-term care rider. You may have an annuity. If you're a veteran, there may be skilled nursing, veterans aid and attendance benefits you could use, or of course there's state aid, Medicaid, known in Minnesota as medical assistance. However, if you're planning on Medicaid or the state to take care of you, there's really only one way to receive that care, and it involves a couple of really fun words. You need to either be poor, broke, or destitute typically in order to qualify for state aid. Most people don't plan on that. When you look at the cost of traditional long-term care coverage, there's a couple of things people think of. One, it's obviously expensive. We looked a little bit at the costs. Not only is it expensive, but it's something most people hope they'll never use. Nobody looks forward to being in a nursing home and needing assistance. Third piece of that is, if you do not use it, oftentimes with traditional policies, you lose it and there's no benefit received. So the downside of traditional long-term care insurance, let's touch on those. One, high and rising costs. Premiums can be expensive, especially when purchased later in life. Unfortunately, most people aren't thinking about long-term care and the cost of that when they're in their 30s and 40s, so costs continue to rise the older we get. Many policies are also not guaranteed. There's not a level premium. They oftentimes increase over time, and we're going to look at an actual letter one of my clients received from their traditional long-term care policy. Number two, we talked about use it or lose it. If you never need care, you get nothing in return, no fund, no refund, no benefit, no legacy value. Now, there are some that will have some partial returns of premium, or there may be a little bit of cash value there, but in traditional terms, either use it or lose it. There's also the emotional discomfort. Some people avoid buying it because using it means they're facing serious health declines or issues. It feels like paying for something you hope you never use, which creates a psychological hurdle to get over just to purchase it in the first place. There can also be strict underwriting guidelines. Traditional long-term care insurance often involves rigid health screening, and many applicants are declined. Pre-existing conditions can make it difficult or even impossible to qualify for. Oftentimes, there is also a limited benefit duration. Most policies only cover a set number of years, maybe 2, maybe 5 years on the high end. Oftentimes with care today, people can be confined to a home or need assistance for 10 or 15 years. How are you going to pay for those additional terms if you outlive your benefit period? You're now on your own again, looking for another way to pay for your care. There's also typically no death benefit or cash value. Now, this isn't always the case, but traditional policies, if you die without using the benefit, your family receives nothing. Unlike life insurance, there's no return of premium or cash accumulation. Traditional long-term care insurance can be a good fit for some, but it comes with notable drawbacks, high cost, no value if unused, and no legacy benefit. That's why more clients today are turning to hybrid life insurance policies and solutions that provide a level of flexibility and multiple benefits, whether or not long-term care is ever needed. Now, there's a lot of words on this page, but I just want to highlight a few things. This is an actual letter a client of mine received from their long-term care insurance provider. If you look here at paragraph 2, it says, please be aware as of 7/20 of 2023, we plan to see cumulative rate increases of approximately 159% on certain policies, that is, 159%. That's unbelievable. Another type of policy they have is going to have approximately a 27% increase, a third 75% on different types of policies. And again, if we look at the bottom, if you decide to keep your existing policies, or if you select a settlement option that requires you to pay, there's no guarantee that these fees will not increase in the future. So it can be particularly expensive, again, when purchased later in life. So keep your eye out for these. There's actually less and less insurance providers supplying long-term care options for clients because of the high increase in costs. So they're more and more difficult to find. There's less and less options out there. Traditional long-term care insurance can be a good fit again for some, but again, notable drawbacks, high cost, no value if unused. If we look at some of the comparisons here between traditional long-term care and hybrid life insurance. Long-term care, what does it do? One thing, pays for long-term care. Life insurance with a rider can pay for long-term care, or at minimum, you're still going to have the death benefit in place, so you do get something for those premiums you've paid over all these years. Old long-term care, use it or lose it. Ongoing, often increasing premiums. On the life insurance side, if it's not used, again, the death benefit is paid. Long-term care premiums tend to increase. With life insurance and a long-term care rider, you have a little bit more control over how you pay this. You could choose a level pay, same payment throughout the life of the policy. You could do a lump sum single pay, or some people may choose to pay this over a limited time, maybe a 5, 10, or 20 pay policy with at the end of that, you're paid up in full and still maintain those benefits. Traditional long-term care, often no cash value. Life insurance with a rider, you can build up that cash value. You can leave a legacy behind, and you could also turn that on for tax-free income potentially, whereas the traditional policies are single-purpose products. So again, on the cash value accumulation, this is one of the best kept secrets. A properly structured life insurance policy can allow you to pull out tax-free income during retirement. That means no taxes on withdrawals when done right, which means there's no impact on your Social Security, your IRMA payments. It doesn't impact your taxation, and there are no RMDs required on cash value life insurance. It's flexibility and control when you need it most. You do receive tax-deferred growth. Cash value grows without being taxed annually, similar to most retirement accounts. This allows for the compounding over time, helping build significant value. Again, when structured properly, you've got tax-free access. You can take tax-free policy loans or withdrawals from your cash value. Commonly used to supplement retirement income, could be used for emergencies. I've had clients set up cash value life insurance policies with the intent of funding their children's college. It's also lifelong coverage. Unlike term insurance, policies with cash value are permanent. They last your entire life as long as the premiums are being paid. You've got some financial flexibility. It's a personal cash reserve. The value can be used at any time for any purpose, no questions asked. There's no early withdrawal penalties or income restrictions like you have on IRAs or 401k plans. It also includes legacy protection, still provides a guaranteed death benefit to beneficiaries, even if cash value is accessed during your lifetime. Really what you're doing is you're accessing that death benefit early to provide other benefits. You may also use it as collateral value against a loan. A lot of banks do accept cash value life insurance policies for collateral, offering another level of liquidity for you. Cash value life insurance is really ideal for clients who want tax advantage income, high contribution flexibility, death benefit, and potential long-term care or estate planning features. Roth IRAs are really best for those seeking low-cost tax-free retirement income without the limits. So if you look at some of the comparisons on here, tax treatment, they're both tax-deferred, tax-free distributions. Yes, with a Roth IRA, you can access that cash after 59 and a half, penalty-free, and as long as the 5-year rule has been met. With the cash value life insurance policy, you either are taking out distributions and loans or a combination of the two, as long as it's structured properly, and there are no age limits on this. I've set these up for clients with plans to retire before 59 and a half. They want access to cash to get them through those early retirement years. And again, it has no impact on your income, which may allow you to qualify for other benefits, such as low-cost health insurance. No contribution limits on the cash value. With your Roth IRA, if you meet the income limits, you're limited to $7,000 per year or $8,000 if you're 50 or older. You can access the funds anytime. Death benefit is tax-free, and it often is larger than the actual cash value. With a Roth IRA, there's no death benefit. You just get the account value to pass on. Roth IRAs, there may be some level of asset protection, depends again on the state. There's a lot more creditor protection when you look at a cash value life insurance policy. Again, this varies, but typically more protection on the life insurance side versus IRAs. Market exposure, Roths are self-directed. You got a wide range of investment options. Annuities, the variable life insurance policy is very similar. You can look at a fixed index tied to maybe the S&P 500, NASDAQ, Dow, or there are several mutual fund options available as well. So you've got a lot of investment options that do come along with the cash value life insurance policy. No RMDs required on either. Legacy planning is a great feature of the cash value life insurance policy. You're going to get guaranteed benefit, plus you can utilize it to strategically plan the distribution of your estate. With the Roth IRA, again, passes theirs tax-free, no leverage. They do have requirements on when they need to take those distributions. So again, some of the advantages: generally paid income tax-free. You've got liquidity at death. Your life insurance policy, as long as the beneficiaries are documented appropriately, will avoid probate. It's also predictable. $1 million death benefit is $1 million tax-free. You know exactly what that's going to be, which allows you to plan better for your future. And the payout is leveraged, meaning you're going to get more in the death benefit that you paid in. So again, some of the advantage of a life insurance policy. Now we'll move on, talk a little bit about wealth transfer. It's going to provide liquidity to balance unequal assets. This happens oftentimes if one child inherits a business or a property. A life insurance policy can be used to provide an equivalent cash benefit to the other children or their heirs. For example, family farm. I saw this a lot in a previous life. On the life insurance side, one child may take over the farm or the family business. The other maybe is not interested, yet you want to make sure that that business is able to stay in place and that all children can be taken care of equally. That often takes place through the life insurance policy to buy out the ownership of the uninvolved child in the business or in the farm. Preserves the integrity of key assets, avoids the need to sell or divide a business or home or other legacy assets, and ensures fairness amongst the heirs. Continuity of business succession or real estate holdings. If you're somebody that holds multiple pieces of real estate, not all properties is equal. Children may want one over the other different values. This again is a great way to make sure your estate is spread out equally amongst all of your heirs. Oftentimes, we'll see life insurance policies used to fund the buy-sell agreements of those family businesses. This is a great way, again, to ensure equality. It creates a predictable value upon death, and it's guaranteed income tax-free, again, providing a known liquid amount to plan around, unlike fluctuating assets such as other investments. It's also a very cost-efficient way to transfer assets, oftentimes much less expensive to purchase life insurance than to reallocate or restructure complex holdings. Life insurance can help ensure your legacy is shared fairly without forcing the sale of cherished assets or creating conflict amongst heirs. Now, if you're looking at estate protection, this keeps life insurance proceeds out of your taxable estates. If you're looking at something such as an ILIT, an irrevocable life insurance trust, those assets can be removed from your estate, often saving hundreds of thousands of dollars for large estates. We've seen this take place before. If you look at celebrities as they pass away, they will oftentimes set up irrevocable life insurance trusts to reduce the size of the estate and reduce or oftentimes eliminate estate taxes. The payout from an ILIT, again, is income tax free and will avoid estate taxes when structured properly. You can also then control the distribution of assets. You decide how and when beneficiaries receive the funds. Could be an immediate lump sum. Sometimes you'll see payments staggered over time, or it may be held in a trust for other reasons. I've seen people schedule these where at 20, a beneficiary will receive a certain amount. Oftentimes that's to pay for college, getting them a head start in their young life. Maybe at 30 years old, they receive another lump sum. That's typically when people are maybe getting married, purchasing a first home. So it gives you a lot more control over the distribution of those assets. We talked a little bit about creditor and divorce protection. Assets in the ILIT may be shielded from creditors, from potential lawsuits, and divorcing spouses of beneficiaries. Again, a lot of this is state dependent, but it provides a lot of liquidity and protection. It ensures the cash value is available quickly, oftentimes used to pay estate taxes, debts, or expenses while that estate settles, without the need to sell those property or businesses, which oftentimes have to be sold because of the need to liquidate them quickly. Oftentimes they're sold at a discount for less than they're valued at. Again, impacting all the hard work you put in to build up your estate. Legacy planning, preserve family wealth, ensure it's passed down according to your wishes and timing, oftentimes over generations. Avoiding probate is a big one. Like other trusts, ILIT assets bypass probate, ensuring privacy. Most people do not want everybody with the ability to snoop through their assets, who they gave their money to, how much they had. It makes for a lot faster distribution of the funds. You can fund those buy-sell agreements, often used in business succession planning, to provide funds or key person protection outside of the estate. An ILIT lets you maximize the tax benefits of the life insurance while still retaining control over how your wealth is distributed, protecting both your assets and your legacy. Let's take a look at an actual policy. And again, this is hypothetical, but I wanted to show an actual illustration on how this could be a benefit. Now, in this case, we're looking at 62-year-old female and a 65-year-old male. These prices are standard, non-tobacco, looking for $1 million death benefit. They chose a level premium, and this is a 10-pay policy, so they structured it so that they make 10 payments of $30,387, and then the policy is paid in full. So there's multiple benefits to this. One, obviously, is the death benefit, oftentimes the main reason for purchasing the life insurance policy. And in this case, it happens to have a long-term care rider on it that will provide up to $250,000 for both husband and wife in the case of long-term care needs. Most policies are tied to 2 of 6 ADLs. So a doctor's note saying someone is unable to perform 2 of 6 ADLs then gives them access to the long-term care benefits so they can start to use that. If we look down the line here and we go 10 years out, again, no small amount, but in this case paid in slightly over $300,000, policy is paid in full. Husband and wife are now 72 and 75 years old. If we look to the column on the right with an interest rate earned of 4% annually, it now has a cash surrender value of just about $70,000. So to have this policy in place for 10 years, long-term care protection, $1 million death benefit, at this point, the client has spent $30,000 approximately on this policy. So they could cash it out for $270, they paid $300, cost them, again, $30,000 to have this additional protection over time. If the policy earns more than that, they could be positive on the cash value side as well. They could take out loans. There's a lot of different things they could do to now distribute these assets, maybe to pay part of their retirement income, to supplement their retirement income without having increased income that could impact the taxes they pay on their Social Security, impact their IRMA payments, impact their health care benefits. A lot of things can come into play if we have access to tax-free income, structure this and utilize it properly. So again, to quickly recap, past versus present, life insurance has evolved from basic income replacement to a multifunctional financial tool and includes taxes, estate planning, as well as long-term care. Cash value life insurance offers tax-deferred growth, tax-free income. Again, this can work similar to a Roth IRA for those that don't qualify, or if somebody is maxing out all their other options, great place to store some additional cash where they can earn a reasonable rate of return as well as cover end-of-life needs and potentially long-term care benefits as well. Great tax-free income strategies, again, via loans and withdrawals. If this is used properly, it can be your own personal Roth alternative. Life insurance with long-term care riders, again, is going to provide a death benefit protection with long-term care coverage, which is avoiding the use it or lose it downside of traditional long-term care insurance. Great way to help distribute your wealth fairly when assets like businesses or farms come into play that go to one heir. Life insurance can provide a great equalizer to equalize that value across your heirs. If you're approaching state tax levels, Minnesota about 3 million, about 25 for a couple federally. It can also help you to avoid estate tax, again, keeping more of your hard-earned estate going to your loved ones, the people you want it to go to, versus going to probate or estate taxes. So keep insurance probates out of taxable estates, distribution, control. We've got liquidity and protection. We've got the cash value, similar to a Roth IRA with some additional benefits of the life insurance and the flexibility. Traditional long-term care, insurance with long-term care riders. So we've highlighted the cost. We've now eliminated the use it or lose it provisions that come with many traditional long-term care policies that lack the flexibility. So now we've got dual purpose protection with these modern life insurance policies. Now, life insurance, we can structure these many ways. The key to me is to meet with somebody that has life insurance knowledge, access to multiple carriers, so we can structure this based on your own individual needs. You may have different areas you care more about than others. Your number one benefit may be a death benefit. It could be long-term care. Okay, there could be other things that come into play that are important to you. And by choosing the proper policy, by working with an independent life insurance agent or advisor, like we have here at Paladin, we've got access to all the carriers. we can look for the best policy for your particular situation, which at the end of the day is the most important thing. So life insurance has come a long ways, whether you're looking to protect your family, grow your wealth, plan for long-term care or estate needs. The right life insurance policy can be a very powerful tool. If you don't currently have coverage, or if it's been a little while since you reviewed your existing policy, now's a great time to start that conversation. We can explore whether your current strategy still meets your goals, or if there may be something better suited to where you are today. Let's schedule a time to talk. Be happy to walk you through your options, help you make an informed, confident decision for your future. If you're interested, I would recommend you go to paladinfinancial.com. In the top corner, there's a section called Bookings. That will bring you to the page you see here. You can go right to this page, book an appointment with your current advisor, and start that conversation and get things going today. So again, I really do appreciate everybody taking the time to spend with us today. And remember, life insurance isn't about what happens if you die, it's about what happens while you live. Thanks again for joining us today. Please feel free to contact your investment advisor representative, an agent, with any questions or concerns. We'd be happy to review your existing policy or recommend something that can meet your needs for today and into the future. Thanks for your time. I appreciate it. Again, Jeff Quick with Paladin Financial. Have a great rest of the day.